You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. I love that music because that means it is Education Wednesday. That means it is time for the onslaught of educational material to start heading your way. Yes, it is time for Options Bootcamp, the premier program here for options education. A little bit later, you're going to get a nice dose of OPR coming at you as well. Your 1-2 punch of education here on the old network. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network, welcoming all of you to our just juggernaut of education out there today. So many of you just mainline the educational stuff these days. And we love you all, but also reminding you, hey, there's a lot of other content out there on the network that you folks are missing. Maybe you like futures options. Maybe TWIFO's one for you. Maybe you want to learn about volatility. You got vol views. Maybe you're more in getting a little bit graduating into the more active retail side. Then the double dose of the option block is certainly for you. Getting into crypto and options. Hey, big news this week, right? I saw right before showtime. SIBO buying ErisX on top of that. So the ETF, now this SIBO back in the crypto game in a big way. A lot of stuff going on. Break it all down on TWIFO. Of course, you want to go, crypto rundown. And of course, if you want all of that live and then to go above and beyond with some great pro Q&As, we had the one and only Mr. Tony Saliba in there answering your questions in the pro Q&A hot seat yesterday. It was awesome. You guys asked him about butterflies. Everyone's got butterflies on the brain these days, how to put them on, how to take them off, volatility, crypto. He runs Mercury as well, so he's big on the crypto digital side. So great pro Q&A. If you missed it and you want to participate in future ones and you want to go check that one out for yourselves, theoptionsinsider.com is the place to go to begin your journey to the dark side. Trust me, it's a fun dark side. And maybe you shoot a little force lightning too, which, hey, that's not the worst thing, is it? Maybe ask Vader. It didn't work out too well for him. But hey, I digress. Speaking of the dark side, I am also joined on the program this week by the black-hatted one himself. I'm not sure if he's mastered the force lightning yet. We'll have to check in and find out. He is Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of 1 or 2 or 27 black-hatted options tomes. Mr. P, welcome back to the program. Have you found your old Vader helmet? Have you fished it out of the garbage, sir?
Oh, yeah. But, I got to tell you, that shooting the lightning through the fingertips, that's tough, man. I can't figure that shit out.
Takes a while. It takes a while to master that one there as we keep on. Actually, before we get into all your onslaught of crazy fun questions out there, because you guys have a ton of them this week. Mr. Dan, I know you've been busy. Speaking of black-hatted stuff, when you're not talking to me, you're busy out there raiding all these crazy meme stocks. So forget the cutlass like we talked about last time. This time, you got a lightsaber in hand. Mr. P, what have you been raiding these days?
Ooh, man, I'll tell you what, Options Raider is, man, it is so fun to trade, first of all, but it's been actually going really well. Let's see here. Traded some AMC and some Wish successfully recently, just over the last couple of days. And that went pretty darn well. So, yeah, it's going great. It's fun to trade, and I love it. I love it. I love it. I love it, Mark.
I just like saying it. I like saying options rater. It sounds fun. So you want to do some rating? Maybe we'll raid some of your emails now. How does that sound? I'm going to purloin your own branding, Dan, as we head right on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's get to it. You folks hit us up hot and heavy, as I expected, especially after last week's show tackled an interesting topic. We'll get to all that in a second. First, let's pay off some of the questions we've been asking you folks of late. Last week, we had a really interesting, really kind of contentious poll for you folks. We asked you quite simply, we've seen an explosion of new traders in the last 18 months in particular, but when did you start trading options? And we gave you 4 ranges, of course, post-pandemic or post-Great Financial Crisis, so sometime between 2008 and the pandemic. And then the dot-com bust period, so right after the meltdown in 2000 all the way through to, let's say, the Great Financial Crisis in around 2008. Or maybe you come from the old-school market maker trader path like Dan and myself walked before we chatted with you folks here on the show. And Mr. Dan, the post-Great Financial Crisis, so sometime between 2008 and the pandemic, won with 44.7% of the vote. What really interested me, though, Dan, was the number 2 response, which was the post-pandemic. Now, I know for a show like this, a lot of the audience has joined in that, but it's always interesting to see it in actual stark relief and actual numbers. And for our overall Twitter poll we put out, this is to the full Twitter audience, not just for this show. 30.1% said they started trading options post-pandemic. So sometime in the last 18 or so months, Dan, does that surprise you, or is that kind of what you expected?
That is kind of, I think that is kind of what I would expect, I mean, there's been a good number of people who started trading, post and during pandemic, so yeah, I bet that's probably about right.
By the way, we can hear your Raider machine running in the background, those little nuggets. So go turn off your rating noises while I update us on this week's poll. By the way, the other 2, we had a dot-com bust period right around 15% and close to 11% for the old school market maker trader, which I know the latter, that kind of lines up with how many pros are circling around out there in our audience. I know we have a lot of you, but obviously you can't touch the legions that have entered in the marketplace since the pandemic. This week, our question is related. Last week we asked you when you started trading options. This week we're asking you why. Very simple, why you started trading options. And of course, as usual, if you don't see your actual reason below, we encourage you to follow up with your reasons there. We gave you 4 choices. Again, it's hard to encapsulate all of the reasons you might want to trade options in just 4 choices. We endeavored to do so. Catching the meme stock wave. That's our first choice, followed by hedging your stock portfolio, followed by you want to amplify, turn up the leverage on your stock portfolio. And the 4th choice we gave you is that you graduated from trading futures. You started trading futures and you said, I want to turn this up to 11. Let me go on out to ye old options. Mr. Dan, I will ask you before I reveal the results, what do you think is winning our poll, sir?
I am going to say, it's tough because I would think that people who just started within the last year would answer to catch the meme stock wave. I think that would be the big one right there. But if we're going, all times, people who started 20 years ago as well, there's going to be more of them. So I guess I'm going to go with, I'm going to think that people answered higher portfolio leverage.
Interesting. Let us see what the massives have. And you are correct. 58.8% right now, Dan, saying higher portfolio leverage. So running away with it. Number 2 is actually graduated from futures. That kind of surprised me. We kind of threw that in on a bit of a whim, but these days commodities and those types of exposures are getting more prevalent with a lot of you out there. Maybe you're just using them to get access to things like the E-mini. That's a very popular trade, and the micros have certainly made them more popular for a lot of folks. That certainly could be a growing vector. And clearly from the numbers, it is. Number 3 behind graduating from futures is hedging your stock portfolio with 11.8%. And catching the meme stock wave, Dan, only 5.9%. Isn't that surprising?
Wow, that is surprising, man. That's really surprising.
I don't know what's going on. These two polls are kind of at loggerheads a little bit, but interesting. Nonetheless, we love what you folks have to say. A lot of you chiming in with other reasons why you started trading options. There's a few of them here. Here's one of them. I just like this guy's handle. That's why I get to read him on the network. Age of Del Aquarius. I just like that. He says he started working on a trading desk after he got his Series 7 and Series 63s. He didn't want to spend his life doing mutual funds. I hear that. I've always been good in math. Learning options seemed an easier path than fixed income. I don't know about easier. No one's ever really called options easier. Certainly more exciting, I would say, than fixed income. Fixed income to me, just that path, that way lies boredom. But hey, to each their own. Interesting stuff. So he obviously would fall in more of the 11% of the pro category of our audience from last week. But we love to hear from all of you out there. Let's get out to it now. Dan, a lot of people had thoughts on our show of last week. Let's just get to a couple of them here. Let's go to the leading edge first. You know this guy's good or gal because they're on the leading edge. It says so right in their name. They say, I loved the This Is Not Normal episode. That was the title of our episode last week, listeners. It says, you guys really spoke a lot of truth on that episode that people need to hear. I actually forwarded it to a few of my ape friends who do nothing but hodl. So they hold on for dear life. For those of you who don't know the acronyms, listeners, they hodl AMC and GameStop and Doge. Oh my goodness. Hopefully you guys will set them straight. So there you go, Dan. We spoke some truth to her that she liked, and she actually sent it to a few of her ape friends. What do you think?
I love it, man. I love it. Our message, I think that both Mark and I, we've been doing this long enough and we kind of evolve, we evolve with it. And so our message, I think, is sort of that classic trader, I'm trying to make money and not hodl the whole time. But that said, we do take advantage of some of these new strategies like the short squeezes and memes and, just lots of different stuff. Got to keep evolving, man. Keep evolving.
Indeed. Let's go on into our next question, which is of a similar bent. This one comes from Tegan. He or she, probably she, I'm guessing. Tegan, let's go with she. Why not? Bring the ladies on the show out here. It says, thanks so much for putting out last week's episode. Well, you're welcome, Tegan. More people need to hear this stuff. As a card-carrying member of the post-pandemic crowd, I'm still grappling with a lot of this myself. I think a VIX of 20 seems pretty low. Your episode steered me away from loading up on the VIX 30 calls. Ooh, well, you're welcome there, Tegan. You guys are the best. Thanks for all that you do, and keep educating us noobs. You guys call yourselves noobs. You're not noobs. You're listening to a show like this. So first off, that elevates you above many of the unwashed masses out there who are only getting their info from, let's say, God forbid, a TikTok or maybe a Reddit or some of those other places where you just don't know what you're getting out there. Some of it could be good, but the lion's share of it, probably not. So you've already taken the proactive steps out there, Tegan. I get the sentiment. If you come into the market recently and you saw VIX was close to 80 not that long ago and it just dropped below 30, you might have just in your head, oh, this quote unquote stock to you, because it seems like a stock, is completely undervalued. I should scoop it here. So I could see why you would have that sentiment to want to load up on that 30 strike, which is one of the reasons why you put out that episode. Hopefully we could walk you back. Not to say it can't spike and you can't hit a home run on those, but it's not the most likely, shall we say, of trades, nor is loading up on the 30s the best way to express that viewpoint if you have it. So interesting stuff. Dan, we're 2 for 2 here, folks. Loving the It's Not Normal, turning them away from the dark side, sir.
I know, man. I know. So as far as still grappling, okay, I think a VIX of 20, I'm going to tell you, Mark, I got a little bit distracted because I had another options trader.
Were you rating? I heard that little alert go off. Were you rating again? You got to stop rating during the show.
I know, man. I'm totally sorry.
Dan's just rating left and right over. Well, at least tell us what you're rating this time. At least do us that courtesy.
Well, SOS popped up, and it popped up earlier, and the folks who got in earlier, it was really fantastic. But I just got in now on SOS, and that stock's up 17% on the day. So that's a pretty exciting one to get in. So yeah, I had to do it, Mark. Sorry.
Now, if you're rating this, are you going up on your cheapy calls? Are you going in the underlying? What's your preferred rating? This thing's trading $2.76 right now, listeners. So what's your preferred MO for a cheapie like that?
Yeah, it's tricky. But that one, I just bought a bunch of the October 29th 3.5 call.
Interesting. So you're the guy I'm seeing coming up on all of our odd block sessions, people loading up on out of the money calls on these cheapy names. It's now Dan. I can now attribute it to a person. Now I can say, oh, that's Dan and his rating again.
Well, you look at the chart. So it's at 275 right now. But I mean, in February, it traded up at 1588. And so, this is one of those where it's got a really high short interest. And everybody's watching it, and I mean they're just trading. I mean, look at the volume in there. It's just thousands and thousands and thousands of contracts going up, driving up the implied volatility, which normally I'm against. Normally that's an unfavorable thing, but here that just means more conviction and potential for a gamma squeeze. So so I like those real cheapos.
You heard it here first. Dan likes the cheapos. Thank you for your write in there, Tegan. We're with you. SOS, another one of these Chinese IT names. Mr. Rock Lobster and I have been kind of sucked into one of the educational front in China with EDU out there. That's been one of the ones we sold some puts on it, kind of as a bit of a lark. And it actually has been working out. Stock's back up to $2.50. I wonder if I got filled in my calls today. I'll have to go check and see. I'm trying to sell the 2 halves, listeners, for $0.25 out there. And they're messing around with me out there. I'll happily sell those. All right. Let's keep on rolling here. We're busy trading during our shows, listeners. How dare we? All right. Next up, Stephen Womack. Oh, this guy, Dan, look at this. He's a award-winning novelist. He won Edgar and Seamus award-winning novels. He's written screenplays. He's a retired film school professor. He's got a novel out there right now, Moonlight Over the Loveless Motel. See, Dan, I always knew we had a very just diverse, well-educated audience out there who are clearly very discerning and very intelligent. And now this confirms that, Dan.
I know. Hey, Stephen has been in some of our classes. Nice to hear from you here, Stephen. Awesome.
Oh, so now I can't say he has discerning taste because he's actually gone. He knows you now, so I have to hold that against him. Well done, Dan. You had to color my perspective on Stephen. Let's just keep on rolling. Let's forget all that happened here. All right. He says, hi, Mark and Dan. After Branson's successful launch, I bought a CSP in space. Now, that's my first question I have here. CSP usually stands for cash secured put. You can't really buy a cash secured put. So that's kind of my first question. Usually a cash secured put, listeners, are you going to sell a put and then you're securing it with cash because you're putting aside enough capital to buy the stock at the strike if it should break through it. So that's what a cash secured put is. So usually you're selling a cash secured put, but I digress. Let's read the rest of it. Maybe it makes sense. I bought a cash secured put in space with a 38 strike. Since then, it's dropped 50%. Oh my. I've rolled it a few times to lower my cost basis, but it's still an amazing loser. Ooh. Should I close and take my losses or let the cash secured put be assigned? All right, so he's shorted then. So he is selling. I think it's just got the terminology a little bit mixed up. And hold onto the stock in hopes it'll eventually come back. The expiration date is this Friday, October 22nd. Thanks. Well, yeah, I haven't, space was on a lot of people's radar. It was on a lot of our scans for the odd block and stuff a few months back. And that sounds like when you got into it there, Steve. I'm looking at it right now. You're right. It's trading about $20.20. So, yeah, you're right. Pretty much cut in half. It's looking at this chart. It hasn't come back on our radar in the last couple of months. And since June, it has sold off quite a bit. Got up to $62, almost $63. That obviously was right around the height of all that launch. And then it's pretty much done nothing but sell off ever since. So my condolences there on your trade there, Stephen. I'm still a little confused, though. You say you bought the cash. I think you sold it, but you said it was a 38 strike, but you also say you rolled it a few times. So is the 38 strike what you've rolled to, or is that what you started off with and you've rolled other strikes? So Dan, I'm going to read this as he sold a cash secured put in space with the stock around 18 points higher. He's at the 38 strike. The stock's at about $20 right now, and his puts are about to expire. He says he's rolled it down. I'm not really sure what he's done. He hasn't given us all the specifics there. But what are your thoughts here? He sold it. It's kind of in his face for quite a bit, and it's going the way of the dodo on Friday. At this point, there's not a lot you can do. The erosion has ticked out of this. You're kind of getting what you're getting. But I'm curious if you have any thoughts for our award-winning novelist here, Stephen.
Well, this is one of the big tenets of the MTM Smart Income system, which is our cash secured put and covered call system. And like it starts with your objective. And I know that sounds so just, plain, so fundamental, but it is like all good trading starts with the fundamentals. All good anything starts with the fundamentals, right? And so like it starts with your objective. Like when you put it, like you can have two objectives with covered calls or cash secured puts, skate or trade. And skate means, hey, the stock's up at 40 or whatever. I'm going to sell the 38 puts, and I hope to see the stock not go below 38 and skate and just keep the money, right? Or your objective could be to trade into the stock position. So it could be, hey, the stock's at 40. I'm going to sell the 38 puts, and I hope I get a sign because I want to buy this stock at 38, right? And so to me, the most important thing is that before you're even in this situation, you know what that objective is. Like, what you want to have happen. And my guess is that you want it to skate, which didn't. And so, okay, fine. Maybe things didn't go as planned, or maybe the plan could have been a little bit tighter up front. But now what do? Like, if you didn't have this position on now, would you put it on now at this strike at current prices? And if the answer is no, you probably ought to just close it, take the lumps and move on. If you do, or put on a trade that you do want, right? That does make sense to you. So, it's really hard without knowing the like what you want to do, why you put the trade on in the first place. It's impossible to answer, but just think of it that way. Think, hey, like, let's pretend I'm not down money. I never put this trade on. I never rolled anything. I'm looking at this with fresh eyes today. If I were to trade space right now, what position would I want? And that's the one you should have on. If you have on anything other than that, you shouldn't. You should close it and put that on. Easy.
Yeah. I mean, that's pretty much it. If you wanted the stock at 38, hopefully that's what you wanted. That sounds like what you're getting. And then, you have options. Like Dan said, if you don't want the stock, you can close it, take your hit, and move on to another trade. If you still like the stock, you can take it. And then there are things you can do. If you think it is poised for maybe a recovery, there's things we talked about in the past, like stock repair type trades, which for a scenario like this, where it's sold off 50%, that's kind of the scenario we start thinking about those. Usually that involves buying, a meteor call somewhere around at the money and then selling two farther out. So now effectively, and you don't have to go all the way back to your break-even strike. That's the nice thing. You can lower your break-even cost at that point. So you can maybe make it somewhere a half. So it doesn't have to go all the way back. It can just go maybe part of the way back. So those are interesting things. That is, if you still have a bullish outlook on space. If you're done with space, and I could certainly understand it, then yeah, just wash your hands of this one. Sometimes they're painful lessons, but they are lessons. And then you move on to live to fight another day. All right, let's go on out to this one. Let's go to Mark Davis. He says, hello. Well, hello, Mark. He says, it was mentioned in episode 23 of Options Bootcamp. Well, he's going back. Wow, episode 23. That there was a more efficient way through the use of options to clone the idea of these leveraged plus or minus 3x leveraged funds. I'm trying to wrap my brain around how this would work. Would I just purchase LEAPS contracts up to 300% of my account as margin allows, or is there something else I'm not aware of? I assume in the long run, while playing with fire risk-wise due to the higher management fees of these levered funds, I'd come out ahead versus buying shares of them at the, i.e. 300% SPY versus the SPXL. Those are the two he's looking at. Thanks for the information. Also, has there been a show done yet that covers the complexities of taxes on options? The more I read, the more confused I become. Well, the latter, I can answer that one for you right now. The answer to that is no. We've touched on it a few times. None of us are obviously CPAs here, so you start getting into tax advice. People get a little skittish coming on the network and talking about taxes with options. But, it is an intriguing thing. We have touched on it a little bit more on our advisors option program. But, your question kind of brings it up. I was thinking about it maybe more along the lines of that program. because obviously the asset managers and advisors, they live in that tax environment. So that's kind of what they need to talk about. So I was thinking about bringing on some people to kind of do a deep dive into that on the show. So look for it maybe there coming soon, but I'll let you guys know on this show as well if we do decide to do a bit of a deeper dive, because you're right. It is different. You know, it's not just like you buy a stock and then you sell it. It's pretty easy to figure out where you entered, where you exited, and it's pretty easy to figure out if it's long-term or short-term. That's kind of really the only math you have to do in stock, unless you have to, a bunch of different positions you have to somehow aggregate. But outside of that, options become a lot more complicated. And so I could see why you have questions. So that might not be the worst subject for a show like this. But getting back to his other question here, Mr. Dan, he's talking about episode 23. So obviously I don't remember our specific conversation from episode 23. You have to go back and listen to refresh myself. But I can probably infer, knowing how we've talked about these in the past, I've frequently referred to these levered products as Franken products, because they kind of go out and they cobble together something, typically using derivatives, to try to approximate these 2x, 3x returns, whatever they're trying to do. And it's up to the product how well that's done. And usually the answer is not that great. And usually the answer is also there's a huge fee associated with that. So that's why I've taken a dim view on these before. I said if you have some savvy in options, you could replicate a higher leverage position. Look at our audience. Most of the people responding have said they want to use options for leverage. That's clearly a popular use case. So Mr. Dan, he says he thinks about using leaps. You don't need to use leaps. You don't need to go crazy. But let's say someone comes to you like Mark with a question like this, and he says, hey, I'm looking to maybe try to replicate one of these, levered ETFs, but do it myself, do it in a more strategic way using options. What would you recommend to them, sir?
Well, I mean, the one thing to keep in mind, Mark Davis, is that options are different than the underlying. Like the underlying is what a friend of mine who used to work at Citadel a while back, a friend of mine who used to work at Citadel would call stocks and futures linear products, because it's like it goes up or it goes down, and that's it. That's all your profitability or loss. But with options, there's the up or down, there's delta, there's also time passing, theta, there's also volatility changing, vega, rho theoretically, which probably one day not in the too distant future is going to come into play. So just keep in mind that if you just buy a bunch of leaps, you're buying a bunch of option premium that comes along with that, which has value. Like you're literally trading. When you're trading options, you're trading options. You're not just trading the substitute for the underlying. You're getting all this other stuff that really provides you an advantage, provides you something else to think about and something else to try and make money on. So, yeah, I mean, a more pure way to get leverage like that is maybe to do something like like a synthetic stock, buy the call and sell the same strike put. You can typically get about 5-to-1 leverage, I think, with a lot of brokerage firms out there. There's the more leverage you get, the more risk, caveat. But so just keep that in mind. If you're doing anything except synthetic stock, you have optionality that you're also trading. That's not just directional.
Yeah, there's a lot of ways we can do it. Maybe we should devote a whole show to this, but in general, you don't need to go into leaps. You could do it just the capital efficiency way that Dan was talking about, using synthetic stock. You can obviously use in-the-money options as kind of a more synthetic approximate. Obviously, every contract's going to be 100 shares, so you could do the 3-to-1 if you want to replicate that ratio on something a little bit nearer dated to what you're doing. Obviously, there's other things going on with that. Like we said many times, there's Greeks and things involved. So it has to be a little bit more, you have to be a little bit more nuanced and have a better understanding of options. But if you want to amplify your leverage on a particular underlying and don't want to be beholden to however a typical product is doing it, then you can do it, and you don't need to be stuck in the leaps. You can go nearer dated options, and whatever you want to scale it up, 2x, 3x. It's not a crazy formula. It kind of depends on what you want to do. We don't have too much time to get into more detail now. Maybe that's an interesting topic for a future show. We're kind of coming up against, so let's see if I can squeeze in. Let's go to, our old buddy Chinggis, a.k.a. Genghis Khan here, Akatayev. He says, hello, gentlemen. I love our very polite audience. I loved episode 156. This is not normal. Well, thank you. I fall into that fresh meat category that entered trading during the GameStop saga. Oh, so he's a newcomer. and I got sucked into options 3 months ago after avoiding it for 6 months since January of 2021. This episode was really insightful. Well, I'm glad we could help you there, Chinggis, and everyone else who had similar sentiments about that episode. It seemed like a well-timed episode. It needed to be done. He says, I do have a question around market makers hedging. Since they hedge almost every trade to be delta neutral, how many options need to be traded to have a large reaction from market makers to hedge that? So the price of futures will move fast in one or the other direction. And how can they hedge it so fast? Love the podcast. Added Options Insider, The Option Block, and TWIFO to the list of podcasts, which I listen to religiously. Well, if you're into the futures, it sounds like you are, then definitely want to add TWIFO to that. And the others, like I said, I'm a fan of all of our shows. But yeah, to whatever you're trading, we have a show out there for you here. He says, so the hedging, the delta neutral side, how do they do it so quickly? Well, a couple of things. Obviously, when they're hedging, it's a very fast process. It's all automated now. I mean, I used to put up a trade and then, use whatever. I have a handheld console, or maybe for some of the larger prints, I would actually have a broker near my trading pit that I would signal using the old school hand signals. How antiquated does that seem now? And say, hey, sell whatever, 10,000, 20,000, 50,000 shares of whatever it was, Intel. Or if it was the case of the S&P, you want to do the E-minis or the big S&P futures to hedge against your SPX. And it was all a pretty seamless process. It was all set up to get those trades in pretty quickly. Now it's done. A lot of these programs, they delta hedge almost automatically, if not instantaneously. They put on a trade, they instantly can calculate the delta exposure, and then it's just a straight underlying trade. So that's easy to do. You got to sell futures, you got to sell stock or buy them, whatever the case may be. That kind of delta one trade is a pretty fast thing to get done. So that's pretty easy to get that stuff done. That's how they hedge so fast. They're geared to do exactly that. It's pretty much automatic now. Let's see. How many options have to be traded to have a large reaction from the market maker? Well, if you see a big options trade going up, that is true. There will be a counterpoint to that usually in the stock from the market makers coming in and hedging. And you would in the past sometimes, if people knew about an order ahead of time, they wouldn't front run the options so much. They would come in and front run the stock quite a bit. They would come in and say, let's say they knew that market makers had to buy, I don't know, hundreds of thousands, millions of shares in XYZ name to hedge against some puts that they had to buy coming up. Well, they would come in and front run, just buy the stock, and then they would get a nice pop out of it, 10 cents, 15 cents, a quarter, who knew? And then dump it. And that was usually the easier route really to go to front run these trades versus the options. That's a little bit more obvious and kind of harder to get in and out of it. Stock, you can get in and out pretty easily. So yeah, Dan, you have any thoughts on this one? He wants to know, how do market makers hedge almost every trade to be delta neutral? That's kind of pretty easy. How many options need to be traded to have a large reaction from market makers to hedge? And how can they do it so fast, sir?
Yeah. So as far as question one and question two there. So, I mean, look, man, back in the day when Mark and I were trading like in the pits before everything was electronic and automated, like Mark just described, I mean, we would literally just hedge manually. Like I would get on the phone, dial a phone number, call the desk and say, hey, buy me, 300 shares, right? So, there is a little bit of a delay, which is bad. It's largely eliminated now because it's automated. Mark, I think you were in the SPX, so you would just flash it to your clerk, right?
Yeah, you just arb it to your clerk how many futures you wanted to sell or buy, and that was about it. Took 2 seconds.
Yeah. But as far as like, where's the one question? To have a large reaction, from the market makers. Well, what's a large reaction? I mean, look, basically, if you get to the point of having enough deltas to be 100 shares or one future, long or short, you're probably hedging that. And if somebody comes in and sells 1,000 calls and you've got to trade 18,000 shares or 18 or 180 futures or whatever it comes out to, then that's what you're going to do. Market makers are always reacting, not acting. So, it's just incidental, however big the trade is. So, yeah, I mean, I hope that helps.
All right. Yeah, bunch of questions in there, Chinggis. I think you also sent something. You're coming into Chicago. I hope you enjoy your trip to Chicago. Unfortunately, Studio here, as we mentioned before, closed to audience and visitors still these days. We'll get it back open one of these days, and we can have all you fun folks in here. But I hope you do enjoy your trip to Chicago, Mr. Genghis Khan. I just like saying that out there. But unfortunately, Mr. Dan, that music means we're up against it here today. Brian's waiting out in the wings, listeners. He's going to hop on here. Unfortunately, for those of you listening live, Brian's going live to tape. He'll be recording with our producers. And we got him live couple of weeks ago. It's hard to get them live more often than that. That's just the way it is over there with compliance and everything else. Well, we'll get them back live. In the meantime, if you're listening after the fact, this is all meaningless to you because you'll get it on demand right after you get Options Bootcamp out there. But before we go, Mr. Dan, if folks, they want to see what all the fuss is about, all these noises you're making, all the fun you're having on the rating, where should they go? What should they do?
Well, you can head on over to markettaker.com and you can actually join free. We've got a lot of really great free classes, particularly great for beginners, but we've got some advanced stuff there too. So yeah, join us. We would love to have you part of the MTM family.
MarketTaker.com is the place to go. Of course, you don't have to go anywhere if you want to listen to more of our great content. If you subscribe to the full network, it's all coming at you. If you haven't, what the heck are you waiting for? A lot of great stuff, as Chinggis and everyone else have discovered. Whatever your tastes are from an options perspective, we probably got something there, close to a dozen shows there now, something there that will float your fancy out there. And of course, if you want to go above and beyond, great pro Q&As, options oddities, all the live, all the secret club fun, then theoptionsinsider.com/pro is the place to go. We got to get on out of here, but we'll be back again next Education Wednesday, another episode of Options Bootcamp. We'll see you then.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.